Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Bank of Baroda management waiting by. So let's go straight over to Lata. She is in conversation with PS Jayakumar of Bank of Baroda. Lata, over to you.
Yes, we have moved over to the bigger studio because we have a very big guest with us today. We have with us Mr. Jayakumar, the Managing Director of Bank of Baroda. The numbers have definitely enthused investors. We've seen a lot of buy reports and positive reports that have come from investors. It's a 20% domestic loan growth and a definite fall in the extent of slippages. Mr. Jayakumar, congratulations. Thank you very much for dropping by in our studio.
Thank you. Thank you very much.
Well, let us start with a bit of how you see this growth going forward. 20% domestic loan growth and even an overall loan growth that is positive. Is this maintainable?
I would think so. I think we have put together the necessary enabling infrastructure. We got better distribution, improving productivity, ticket sizes are better. As far as the corporate customers are concerned, a much wider suite of product, much more calling plan, a better sculled out target market. So I think on the balance, I would think we should be able to maintain the growth, and guidance is between 15 to 20%.
Okay.
For the loan book for this year.
Okay.
One question that I would like to ask Mr. Jayakumar is that your credit cost has been falling, and at 1.7% as per calculation is on the lowest in last 12 quarters.
Yes.
So given the fact that you arrested slippages in the current quarter, how do you see credit cost panning out, that you are on a PCR or provision coverage ratio of 69%?
I would hope the net NPA numbers would come down, barring some imponderables. I think we should continue to keep course to reducing NPA. But, you know, I would rather wait for 1 or 2 more quarters before completely confirming that the NPA issue is behind us completely. The heartening fact is that our SMA 1 and 2 are also at the lowest level. So even if they slip, you know, the amounts in consideration should be lower. Also, as you know, many of the NCLT and other matters are coming now more closer to conclusion. So there should be a certain amount of rebound coming from there. So when you juxtapose all these things, it will be a reasonable conclusion. I would think that barring some surprises, we should be okay as far as the NPA numbers is concerned. As far as the provision numbers are concerned, there could be some volatility. They could arise because of the fact that some of the accounts are under review, forensic and other things, and then it's possible that the provision numbers are moved up. But that's only a catch-up. If anything goes up in the next 2 quarters, it will reverse in the last quarter. So overall, I think we're looking for a reasonable growth, a contained NPA, and probably a 6 to 8% return on equity in this financial year.
6 to 8% return on equity
this financial year.
Okay. Well, let me just take Abhishek's point forward. We've broken news that the Reserve Bank has a fresh list of companies in a second round of asset quality review. Now, can you tell us whether that will mean higher recognition for you? Or is it, you know, much higher provisioning than this 170 basis points indicates?
Let's wait for the exercise to get completed. We also have a set of list of names that we are in discussion with the RBI. In our view, the classifications that we have made are quite appropriate. That additional provisions is not required, but this is an industry-wide review. So I think when they get everything together, we'll get to know about it. But as I say, if something is increased in this quarter, or then I think we can see the aging provisions subsequently reducing. So it's end of the day, as the year goes by, maybe we'll be able to balance it out. That's really my expectation.
Okay, so I mean, is the provisioning likely to be higher than what you have guided for? In fact, what have you guided for in terms of provisioning?
So the guidance we have given so far as the provisions are concerned is something in the plus minus 3,000 crores of what was reported in March of 2018. And we stay with the guidance. If anything, we should avoid the 3,000 crores growth, and we should be either flat or we should be declining, but we have to wait for that to happen. I think if we put a right amount of work and some of the NCLT assumptions holds good, then I think we should come at those numbers.
Talking about NCLT cases, you are one of the major lender wherein you are the leader in consortium lenders. So we saw in this quarter also your NCLT list 1 actually reduced. You saw some recovery over there. How do you see the NCLT list 1 getting subsided in the coming quarters? quarters, and by when can you see meaningful, NCLT list to resolution?
Well, I would think, see, whenever a new regulation is introduced, there is certain amount of analogies, precedents that need to get set up. There are arguments in the court. But I think by the end of this financial year, we should see a reasonable closure. That's the expectation from my side. But we have to watch for that. And I think we have to be a little bit patient in expecting results from NCLT.
You have your NCLT exposure to the number of companies in the first NCLT list, 12 companies, has come down from 7,000 crore to 5,800. Is this because you sold one steel company's loans?
No, we had a reduction on account of Bhushan. We did sell one more steel company loan, but they're not reflected in the financials because they happened after 30th of June. Okay. So it will flow through in this financial year.
Okay, so how much will your exposure reduce in the current quarter?
I think we have a total outstanding of about 900 crores or thereabouts. It's not very large in the way. It's a reasonable number. So we should see that declining, yes.
Okay, yes. We did hear that you sold your SR loans for as high as 70 paise to the rupee.
No, the pricing was good because a lot of people expect they will get full recovery of their principal. But from our perspective, it is about reducing uncertainty overall in a total balance sheet. So as and when we get good prices, our intention is to sell. Though in theory, if you waited for some more time, you might make better. The realization may be better than selling it out. But much of it is also about reducing uncertainty and also freeing up management time to focus on business.
So one question on the international book. This quarter we saw an NPA increase over there. Could you highlight as to what happened over there and how do you see the recovery from those NPAs?
I think a little bit of it is on account of exchange rate changes that are there, and some of them are a few accounts that slipped. But we don't see anything worrisome in the international book. If anything, our coverage ratios, I think, are north of 70%. I think it's around 75%. And I think there'll be some clawback that will happen. For some period of time, these accounts are contained in SMA 1 and 2, and then at some point of time, they move forward. But nothing that worries us that much. These are EPC contractors. These are certain other steel company subsidiaries. So I think some of them are indeed in the process of resolution.
Okay. Well, I know your growth is very good, but we are still persisting on asset quality for a couple of more questions.
Sure.
You have reported what about 3,000 crores this time in terms of 4,700 in terms of slippages.
Yes.
How much of this is SME? Because many banks have reported higher and higher SME problems.
I think we had a specific disclosure on SME, and the point is that our net flows from SME have been declining quarter to quarter on a net basis. So the portfolio is reasonably stable as far as is concerned. The other thing is that the approach is to originate loans from a number of areas and also to focus on quality. And much as we have done in the consumer business in terms of score-based lending, something similar is also happening in the MSME business. There is a CIBIL CRA score rating, which is very nicely rank ordering, and we're just following the same.
That is for the henceforth. That is, for the loans that have been originated under your tenure.
Right.
But you have inherited a legacy of loans and a legacy of problems. Demonetization and GST. Therefore, do you think that you can cough up SME loans?
No, I know there has been a lot of concern arising from the performance of the SME loan portfolio. I think what we think is reasonably containable as far as the total portfolio is concerned. Our net slippages are actually reducing quarter to quarter. I think barring some, as usual, the usual caveat relating to some surprises, I think we should be able to manage that quite well. There is also, as you know, some classification changes that were made because of the GST-based recognition of NPA. So some have got deferred on account of that, and we just have to make sure that they would stay performing. But after factoring all of these things into account, I still think we are in a reasonable position as far as the SME is concerned.
So one question on your loan growth that you're targeting between 15 to 20% or north of 15%.
Yeah.
Could you give a breakup in terms of corporate and retail? What are the kind of growth that you are seeing? And are you seeing any capex-based, corporate loans coming up, or we are still in the working capital cycle?
We are seeing. Let me put it this way, that because the corporate book is 2 times of the next largest book, it always tends to, in absolute terms, tends to grow similar to the retail book, and that process of change is some time away. But in terms of the growth, we still see a continuing 25 to 30% growth rate on the retail side, 15% growth rate on the SME side. We expect to grow our agricultural portfolio by between 10 to 15%. And then we expect the corporate portfolio to fill in and give us about 15%. But of course, we have the opportunity to accelerate the corporate growth should we want to do it. And there are good quality credits that are available. And also there is, because of this NCLT and the decisions thereon, the companies are using the opportunity to consolidate the number of bankers they have. And in the scheme of things, we would certainly count as one of the bankers that they would like to have in the portfolio. So in that sense, I think we are seeing an increase in steel exposure in our portfolio, but that's arising because of a now revised debt to EBITDA ratio for these companies, new set of ownerships, and the fact that they are reorganizing their bankers, and in the process we are getting a slightly larger slice of the total exposure relative to what we had earlier lost, earlier got repaid from the earlier transaction.
Let me come to the two issues that investors are looking at most closely for Bank of Baroda. The first of them is mergers.
Yes.
Is it out of the way, or is it still an overhang? I mean, if you have to take on a weaker bank, then investors have a problem.
So here is what it is. I think I wouldn't be able to tell you anything specific is on. I don't know anything more than what you know. But the fact is that should there be mergers, my understanding is that the capital issue of the company that is merged with us would be addressed, and it therefore would not result in a drag into our balance sheet. That said, mergers are also about cultural issues. It's also about integration of systems. We also got to make sure the momentum in our business or the other bank's business is not impacted, and so we have to do a number of things to manage them. But at this point of time, I would rather skip this point because I don't think I don't have anything to suggest or not suggest a merger is on the cards. But I do think that the objective of any such merger would not be to diminish Bank of Baroda, and whatever arrangement comes in will be after dealing with the adequate level of capitalization. But I think I don't see anything in the immediate horizon that I need to talk about or explain. Now, as far as we are concerned, we are also preparing ourselves for merger, not in the sense we anticipate it, but it's a good thing to do so. And this includes building scalable back-end operation structures, being able to build a lot of things on a plug-and-play systems. So if you do have any kind of merger, then we can handle the transition well. But there's nothing on cards, so don't report there is a merger. There's nothing that I know more than what you know.
Okay.
But it's always good to think about this eventuality, because at the end of the day, inorganic growth is also a form of growth.
Okay. Okay, so three things you're telling us. One, it's not imminent in the sense you don't know anything. You have not been told anything about it being immediate. Two, that if it comes, it will come with the requisite capital from the government. And three, you have built a back end which is capable of absorbing inorganic moves.
Just a bit of a nuanced correction to that. What I mean is, I don't have any news. That's really what it is. So I would not keep speculating about it. Okay. Should that scenario happen, let's discuss it. Right now, it's not there.
Okay.
That's number one. Three, the process of building capabilities to deal with merger is an ongoing process, and it is also linked to our own process of a scalability of the architecture. So that's where it is. But I would tend not to focus too much on the merger, because I think if it does happen, and at some point of time it should happen, the capital issues would be addressed, and Bank of Baroda and the other banks should be in a position to be able to handle the transition efficiently.